What do rising real yields mean for investors? While interest rates are often discussed in the context of Federal Reserve policy, the recent move higher in Treasury yields has implications that extend well beyond the bond market. Rising interest rates affect stock valuations, borrowing cost, income opportunities, and long-term financial planning. Treasury yields have climbed to some of their highest levels in years. The 10-year Treasury yield has moved above 4.6%, while the 30-year Treasury yield has remained above 5% for the longest period since 2007. For many investors, that may sound concerning. However, higher yields are not necessarily bad news. In fact, for long-term investors, higher yields can now create opportunities for income generation, portfolio diversification, and financial planning. To understand why, it's important to distinguish between nominal yields and real yields. A nominal yield is simply the stated interest rate on a bond. A real yield takes that one step further by adjusting for inflation. In other words, real yields measure the actual purchasing power investors earn after accounting for rising prices. Because real yields represent the true return available to savers, they serve as a key benchmark for virtually every other asset class. Over the past decade, real yields have experienced a dramatic shift. During 2020, real yields on government bonds actually turned negative. Investors were effectively accepting a guaranteed loss in purchasing power in exchange for the safety of Treasury securities. This was partly the result of Federal Reserve policies designed to stimulate the economy by encouraging investors to move towards stocks, real estate, and other risk assets. That environment has changed significantly. Following the inflation surge that began in 2022, the Federal Reserve raised interest rates aggressively. As inflation concerns increased and policy tightened, both nominal and real yields moved sharply higher. Today, the 10-year Treasury yield is approximately 4.7%, while the corresponding real yield is about 2.4%, levels that are well above what investors have experienced for much of the post-financial crisis period. So what's keeping yields elevated? Several factors are contributing. First, inflation concerns remain present. Higher oil prices and gasoline costs have renewed concerns about future inflation pressures. Markets continue to watch energy prices closely because they can affect a wide range of consumer and business costs throughout the economy. Second, investors are paying close attention to the nation's fiscal position. The U.S. national debt has surpassed $39 trillion, and growing budget deficits raise questions about future government borrowing needs. When investors require additional compensation for holding longer-term government debt, Treasury yields can move higher. This additional compensation is often referred to as the term premium, and it has become a more important part of the conversation in today's market environment. The next question is why these higher real yields matter for investors. The answer is that interest rates affect much more than bonds. They influence how attractive different asset classes appear relative to one another. One way to think about this is through the relationship between bond yields and stock valuations. For many years after the global financial crisis, investors frequently referred to the market environment as TINA, or there is no alternative. With bond yields near zero, investors almost felt compelled to own stocks because there were few attractive income-generating alternatives. Today's environment looks very different. Investors can now earn a meaningful inflation-adjusted return from Treasury securities. At the same time, the S&P 500's earnings yield sits around 4.9%, creating a much different balance between potential reward and risk than investors faced just a few years ago. It's important to note this does not mean stocks are unattractive. Rather, it means that portfolio decisions may require greater attention to the balance between stocks and bonds. With bonds offering higher yields, they once again play a more meaningful role in generating income, managing risk, and supporting long-term financial objectives. Another important factor influencing yields is the Federal Reserve's balance sheet. Following multiple economic crises, the Fed accumulated trillions of dollars of Treasury and mortgage-backed securities, expanding its balance sheet to historically high levels. Even after recent reductions, the Fed still holds assets far above pre-2008 levels. Under Chairman Kevin Warsh, there has been growing discussion around continuing to reduce the Fed's balance sheet. As the Fed allows securities to mature or potentially sells assets into the market, Treasury supply available to investors increases. In general, that process can place upward pressure on interest rates and borrowing costs throughout the economy. Combined with the possibility of future Fed rate increases, these actions could contribute to a higher for longer interest rate environment. When we step back, the broader message is clear. The investment landscape has changed meaningfully from the one investors experienced for much of the last decade. Real yields are now at multi-year highs, bonds offer more attractive inflation-adjusted return, and interest rates are once again influencing asset decisions in a significant way. For investors, this reinforces the importance of maintaining a thoughtfully diversified portfolio aligned with long-term financial goals. Rather than focusing solely on one asset class, today's environment may reward a balanced approach that recognizes opportunities across both stocks and bonds. The bottom line is that rising real yields reflect inflation concerns, fiscal uncertainty, and evolving Federal Reserve policy. While these factors can create market volatility, they also create opportunities for disciplined investors who remain focused on long-term objectives.